Welcome back to the Investing Markets and Money podcast from the Armchair Trader. And today we're joining you from the Resourcing Tomorrow conference in London. And we are going with video as well as audio. So if you're watching us on YouTube, welcome to that. Today I've got Ross Allister joining us on the podcast. He's a managing director at Peel Hunt, where he's also head of mining. And he's going to tell us a little bit more about what's going on in the mining sector. So welcome to the podcast, Ross.
Thank you.
Now, I wanted to start off with the actual Resourcing Tomorrow conference, which you have been involved in. Can you tell us a little bit more about it?
Yeah, absolutely. So I've been coming to the conference for over a decade now, and there's been a bit of an evolution in terms of the purpose of the conference. We used to be called Mines and Money. Now we're Resourcing Tomorrow, and I think that's indicative, of the change in image that both the conference has had to have and also the industry as a whole. It's not about necessarily just putting mining companies together with the people that provide the finance, but there's far more participants from a much broader subset of industry partners coming together to discuss ways we can collaborate, we can potentially change and fundamentally project a different image for the mining sector, the extractive sector, because it's incredibly important for society as a whole.
And we'll come on to the image of the mining industry later on, but you're very well positioned at Peel Hunt. You've got your finger on the pulse of the UK market, UK mining sector. Can you give us your perspective on where that market is? Because it used to be really vibrant, the sort of junior mining sector in London. What's the state of play at the moment?
So Peel Hunt, for context, is a UK independent investment bank. We advise over 150 companies that are listed in London, and the average size of those companies is around £800 million. As you say, because we're very UK focused, we're passionately promoting UK capital markets and trying to ensure that they're effective for our clients and our clients can access capital in the appropriate way. It's fair to say that the markets have had various different challenges, even going back to the time of the financial crisis. There's been a move towards more passive money versus discretionary capital, and therefore a bit of a drying up in terms of capital, and that's been exacerbated by various domestic and international challenges that we've faced. So going back to Brexit, MiFID, the changes in government and in the number of prime ministers we've had. I think we've had as many prime ministers in the last 8 years as we had in the prior 37 years. Add to that the pandemic, botched many budgets, geopolitical tensions, obviously conflict in Ukraine and the Middle East, trade wars. There's been a number of reasons why the market has been challenged. And that's led to a fairly prolonged period where small and mid-cap funds have had redemptions from their funds. And that's meant they've had to focus in on a portfolio of companies that they know, they trust, really the crown jewels from a portfolio manager's perspective. And it's also meant that risk appetite's probably reduced. And therefore, if you're in a sector like ours, it makes it more challenging for them to deploy the capital into a sector whereby you've not just got the capital risks, the mining risks, but you've got the jurisdictional and geopolitical potentially risks as well. So those are some of the challenges. Sometimes I think it takes a diagnosis in order to look at the source of the problem and try and adjust. So thankfully, I do think there is a broad recognition in the industry that we need to change in order to adapt and in order to encourage more people to invest in capital markets. So the FCA have changed certain rules and regulations, particularly on the main market, really to align them with broader international standards. There was a feeling that we were over-regulated. Those changes are now being enacted, which I think should help things. We're also hopefully going to get more reform on the pension side, because I think that's been a big challenge in the UK. There's more to be done, but I think we're moving in the right direction fundamentally. And you should remember that capital markets are cyclical, just like the mining sector is cyclical as well. And so whilst it might look challenging right now, it doesn't mean it's going to be as challenging 6 months or 2 years or 5 years as well. So I do think there's an alignment between where we are as capital markets right now and some of the challenges that the mining sector is facing. I do think there will be more money coming into capital markets and hopefully more money into the mining sector as well. And that's important. It's not just important for junior mining companies that need to access capital to build a mine, for instance. That's important for lots of other areas. So if you're a major mining company, having lots of capital deployed into your stock means you're going to have a higher valuation, which means that when you're looking at acquisitions, you're using your capital more effectively. It's important for private equity because private equity have limited terms in their funds and they'll need to exit portfolio positions. And having the option to IPO a company is very important for them as well, rather than just trying to sell a company. And then it's important, obviously, for those junior miners and for the mid-cap miners as well when they're looking to build their businesses or build new projects. So that's our view on the market right now. I think we're constructive on the outlook now that we've been through a period this year where everyone's been waiting for an election and then waiting for the budget in the UK. The outlook's still slightly uncertain, particularly post the Trump election, but I do think we're in a much better place than we have been.
And from the perspective of the mining sector, is there anything more that could be done to make London a more attractive destination for listing miners?
The key thing for me is capital availability, and it does come into the fund flows into the sector. If you go back to the time of the financial crisis, there were far more mining-specific funds in London. The challenge they had was, along with a lot of other funds, when the financial crisis hit, there was lots of illiquid positions in portfolios, and they struggled to sell that stock effectively into a downward trajectory in the market. That's led to far tighter mandates for those funds, so in terms of the size of company they can invest in and the liquidity, the daily liquidity that they can invest in. And those funds obviously have to be global as well. So there's less mining specialist capital in London, and there's also a constraint on the more generalist type of guys as well. So capital availability is more important. Pension reform, I think, is incredibly important, as I said, as well. I think there's lots of areas where the government, I don't know, budgets are tight at the moment, but there's lots of areas where the government could make small changes that will have an exponential effect in the market. But specifically for mining, I think it is about, we do have a bit of an image problem, I would say, particularly in the UK, because we've got a legacy with coal mining and other areas in the UK, which are perceived to be dirty fossil fuel extraction. And the reality of mining nowadays is very different from the image that's projected. And I don't think the man on the street understands how important it is to have responsible extraction of commodities that fundamentally we use every day. There's probably a number on the table right now.
Yeah, I find that quite ironic. I was at a fund management conference last year where I was talking about the mining sector, and one of the fund managers there said, well, that's not really very ESG, is it? And he was waving around his iPhone as he was talking, which of course is stuffed with metals provided by the mining sector. Do you think that the mining sector could be doing more to educate the man on the street in particular about the fact that there is a lot of work being done to make it more sustainable?
I think we could, and the conference, I think, is a great example of where the right people are speaking. You've got OEMs, you've got governments, you've got other people participating this year. And I think that's important. There's more we could do. There's obviously always more that we could do. But I do think that perception is changing gradually. And having conversations, having debates with friends and family or people at school is part of that. But people need to understand that if it's not grown, then it's going to be mined somewhere. Having a public listing is great from that perspective because it encourages as much transparency as possible. And most investors, institutional investors, will monitor their portfolio companies and their sustainability reporting. So you get that transparency, and all of the clients that we work with are incredibly focused on that area. They're looking at how they can responsibly extract, how they can save on water consumption, on CO2 emissions, lots of different areas, as well as promoting diversity, which is very important as well. So I do think things are changing, but to an extent it's generational. Like it's not going to, you're not going to click your fingers and there's going to be massive change. It does take time to change the image and the perception of an industry.
And can you comment on some of the hot areas of the market? So we following the market, we notice sometimes that the particular area will become very hot. Like, for example, lithium. Yep. Lithium miners went through a phase when they were very interesting to investors. More recently, we've seen a lot of excitement around helium, for example. The helium shortages have been prompting a rush of interest into helium small cap miners. And what are you seeing in terms of the hot areas of the mining sector right now?
And fundamentally, it comes down to supply and demand. I don't know, maybe that I'm being too basic, but one of the problems we've had in the industry is there hasn't been enough investment in exploration, and therefore there's less new discoveries, there's less mining development projects, and therefore projections for supply are going to be declining. So the obvious example is copper, because you've got significantly increasing demand because we need to electrify, we need to keep building, we need to provide the goods and metals that fundamentally we consume on a daily basis. So for copper, I think everyone's fairly aligned that you've got demand going up, you've got supply obviously coming down unless we do something about it, and therefore the prices should be increasing in line with that. Same goes for lithium and helium and other commodities as well. When you're in a more nascent market, you're going to be subject to more volatility and swings in those commodity prices. Lithium's a classic example whereby China's building out a lot of EV and EV infrastructure. They need lithium, but actually lithium availability isn't as scarce as potentially other commodities. And therefore, in a high price environment, you can economically extract almost everywhere. It means that there's going to be a supply response, and prices are probably going to decline. I don't think anyone's particularly worried about new supply of lithium. They're more worried about how you economically extract it in a lower price environment, which is why we're seeing challenges right now. But the other hot area, obviously, this year has been gold. When we've hit all-time highs, they've come off a little bit, but there's a number of geopolitical and other reasons as to why the gold price has remained high, and most gold miners will be making pretty healthy margins at these levels. So there'll be more activity, I think, in that space. Silver probably deserves a mention as well because it's traditionally correlated with gold, but there's also a lot of industrial uses for it as well. So it feels like silver's probably lagged a little bit, and I'd see more upside in the silver price.
And outside of the sort of the guys who are already producers, I mean, what's the sentiment like around the junior mining sector? Because I hear complaints from, for example, the Canadian market as well, where they say the junior miners are not getting any love from investors, and a lot of risk appetite is still off the table at the moment. Is that something you're seeing?
Yeah, absolutely. Fundamentally, it comes down to the capital availability point. Again, risk appetite is still not particularly strong, certainly not in size. And so institutional investors are more focused on lower risk assets. There's a lot of money that's gone into private equity relatively recently, and there's a lot of money potentially from governments in Middle East and everywhere else. But they are very focused on either development-ready projects or already producing assets. There's not enough money going into exploration, and that's a fundamental problem that I think we need to solve for. In terms of how the UK compares versus other markets, I think Australia is a bit of an island from my perspective, and obviously it's an island, but there's an island mentality as well, whereby mining is a much more significant component of their economy as a whole, and therefore I do feel people understand it a little bit more. They're closer to it, they hear more about it, they probably got a different perception of the industry as well, and therefore they're more willing to take risk with earlier stage projects. That said, you do hear other Australian miners, especially the junior guys, complaining about the lack of capital as well. I think London and Toronto are both struggling when it comes to junior miners. One thing that hopefully could change is if we see more M&A activity in the junior end of the market. That's going to attract more investors to say, well, this could be the next thing that's taken out by X major company or large company. So hopefully there's areas where demand can be stimulated.
And is that the same for the financings? Is there appetite for new issues and such like?
There is, but it's constrained, again, by the capital availability point. And this goes across the market as well, not necessarily just in mining, but where we've seen the most activity is for companies that have been established and listed on a stock exchange for a fairly prolonged period of time that have good shareholder registers. If they're going out and buying another company and they need recourse to the market, those shareholders will back them for those type of transactions. In mining, it tends to be, well, recently, the trend is more you try and find one of those private equity groups or strategic type investors that will come in on a fundraise for a specific purpose, and then the market will follow them into that deal, but you've got less of a demand problem to solve for. So there's been less financings overall. And the demand from the market is subject to, I guess, how it's being efficiently deployed, i.e. how the capital is being deployed that a company is raising and the quality and the size of that company.
And talking about the retail market, retail investors, how important are they to the mining sector?
I think they're incredibly important because one of the things investors look at is the liquidity in the stock, and that's predominantly driven by retail investors. A lot of institutions, we talk about free float in banking and on the stock exchange. A lot of institutional investors will buy a stock and hold. They don't necessarily trade in and out on a regular basis, which is fantastic because you've got a permanent source of capital. But the guys that are going to be trading it on a daily basis are going to be the retail guys. There's also been a change to the rules, and I think a very welcome change that we've been campaigning for a period of time, to give retail investors access to transactions, to deals, so that they can participate on the same terms as an institutional investor, because that was deemed to be unfair and justifiably so. You've also got different platforms as well that can provide retail investors access to private companies at an earlier stage, such as crowdfunding, and there's a number of the guys down in Cornwall in particular that have taken advantage of that. So that's really helpful for those earlier stage junior companies that aren't ready for necessarily public markets or for strategic investment, so that they can access that capital. And you can potentially get fantastic uplift, but as everyone knows in the mining sector, your capital is at risk.
And just finally, I wanted to ask you about mining companies that are thinking of coming to list in London. What's your advice to them? I mean, what sort of market should they be looking at? Just like top level for someone who looks at London, because it's something we sometimes get asked about by miners who may be listed somewhere else or are thinking of going with their first listing.
Yeah. I mean, there's no one size fits all, fundamentally. It comes down to the stage of development, whether management team already have a following, whether they've done something else in the past, that might help them. But if you're at early stage exploration, it comes down to the jurisdiction that the asset's located in as well, because there tends to be a jurisdictional bias. If you're in South America, you typically list in Toronto. If you're in Africa, you'd probably list in London. If you're in Asia Pac, you're probably going to list in Australia. That's not always the case, and there's exceptions to those rules, obviously. But it fundamentally comes down to your stage of development. If you're a producing cash generative company, that's fantastic. You should be able to access capital. If you're a development stage company, it's harder, but if you have the strategic backing that you're backfilling for the market, then you should be able to access the market. And if you're earlier stage or junior, you probably want to consider crowdfunding, strategic investor, develop the project, and then come to the market when you're a little bit mature. And these things change all the time as well, because I think if the market comes back, there's more capital, there'll be more demand for IPOs. And in terms of the market that you would go to, there's obviously the AIM market in London and the main market. The strange quirk with the rule changes that have happened is that they're principally focused on the main market, and in some ways the main market's now less regulated than the AIM market. So that's something that the LSE and the FCA need to look at and potentially change. But AIM is still a useful market, I think, for lots of junior companies, because effectively the regulation of an AIM company is, or the responsibility for regulation is with the nomad, which sits in between the company and the stock exchange. So you almost have an outsourced compliance function, which is there to help guide the company through its listing journey and then with its continuing obligations going forward. So for smaller companies, I still think AIM is the appropriate market to grow on. And then once you reach a certain stage, you can go to the main market.
And a few weeks left till the end of the year, looking ahead to 2025. Are you cautiously optimistic about the mining sector?
A boss once told me that you're not paid to be bearish, so it's my job to be positive. Look, I think at the back end of the summer, we were very positive about the market because I think the UK economy is actually probably in a better place than we thought it was going to be. Then we had this sort of anxious wait for the budget. The budget probably didn't produce the results we wanted. And then we had the US election, which is at least it's reduced the uncertainty, but there's still quite a lot of uncertainty around the Trump administration. I don't think we're going to go into a market that's flying next year, but I do think we have removed a lot of uncertainty. And so, yeah, as you say, cautiously optimistic. I do think it will take a bit of time, but I do think the markets here are going to improve.
Fantastic. Well, thank you very much for joining us on the
Pleasure.
podcast today.
Good.
Thanks a lot.
Thank you, Stuart. Cheers.